Thank you. Thank you for joining in today. I hope I'm audible. If at any point I'm not, please indicate via the chat box, etc. So, as usual, let me take you through the monetary policy review today, our assessment of it, and what we think could be market implications of the same. So, as is well known, the RBI chose to keep rates on hold, and the RBI MPC also kept stance at neutral. This was rather broadly expected. If you see, some of the recent interviews of the RBI governor, he has indicated that the bar for the next rate cut is going to be high. Nevertheless, given that inflation is undershooting RBI's previous forecast by a wide margin, and the fact that global growth uncertainties have picked up, there was a section of the market that was nevertheless expecting a rate cut. Uh, and Suffice to say that section was disappointed. Even more so, the commentary accompanying the policy was somewhat on the hawkish side. So, if anything, the MPC RBI are fleshing out, details of why they are on neutral stance. And we would think this basically accounts as what the market terms as a hawkish hold, which means that on the face of it there was no action, but underneath the surface the signals to the marketplace were decidedly hawkish. Now, where are those hawkish elements coming from? Let's just spend a minute analyzing. So, on the face of it, the previous CPI forecast for the current financial year for RBI was 3.7%. That was brought down to 3.1%. Growth for current year is kept constant at 6.5, and for next year, real GDP is pegged at 6.6%. Now, the market was hanging its hat on the fact that as RBI brings down its average inflation forecast for the current financial year, they will have no choice but to accompany that with dovish commentary. However, on that aspect, the market was severely disappointed because, and that is the real, crux of the hawkish element of the policy today, that despite bringing down their average inflation forecast for the current financial year by 60 basis points, the commentary accompanying that is actually quite hawkish. So the RBI MPC are basically saying that bulk of the fall in inflation is on account of the volatile food prices. And if you look at the underlying core inflation, that is hovering just ahead of the 4% area. Not just that, from Q4 this financial year, inflation is expected to head back towards 4%. And for the first quarter of the next financial year, the forecasted CPI inflation is at 4.9%. So, on a straight reading of the matter, and one should not read it straight, but and I'll come to that. But straight reading of the matter, market may very well say that look, if average inflation is creeping up back towards the 4.5 area, your overnight rate is already at or repo rate is already at 5.5. So, where's the question of further rate cuts? So that's the first hawkish element. The second is, in contrast to what one hears from companies and in the ongoing result season, as well as if you see the nominal growth rates of government tax collections, which are all looking quite subdued, the commentary on growth from the RBI actually remains quite optimistic. So they continue to think that consumption is being helped by a rural recovery, that investment is being held by government capex, that services consumption is strong, and the outlook on both services and construction is optimistic. They do note some slowdown in industrial production, and they do flag risks from the external side, including tariffs. But all said, they are quite sanguine on growth and basically looking for inflation to creep up from Q4 this financial year. So all in all, these are the hawkish elements of the policy, and there has been a significant rise in yields today, pretty much 8 to 10 basis points across the board, because market participants or one section of the market may very well take a view that what is left to play for, at least in the near term. Let me address upfront that is not our view, but we will come to that. Now, let's turn to how RBI's reaction function or approach to monetary policy has changed under the new governor and what it has meant for the market. Because we think it's important to distinguish between how much of the bond market volatility that we are currently experiencing is on account of a revision to the way RBI approaches monetary policy, and how much is, basically people just not liking the underlying macro environment and not considering it bond friendly. And the conclusion that we will arrive at is that most of the bond market volatility has to do with RBI's approach to monetary policy in this period, and very much little to do with the global or local macro environment. In fact, I will argue during this call that actually the local and global macro environment is decidedly bond bullish. But first, let's address the RBI's new approach to monetary policy since January of this calendar year. So, as is well known by now, uh, under the new leadership, what the RBI is very focused on doing is give most of the easing that you wanted to do, both through liquidity as well as repo rate cuts upfront, so that the lending agents in the system have time to transmit it to the broader economy quickly and more widespread. So rather than extend the rate cutting cycle so that transmission takes even longer, the approach RBI has chosen is quickly get the rate cuts through, liquidity infusion through, so that transmission can proceed and the benefits of the rate cut can be enjoyed by the broader economy. And so far, so very good. That's exactly what the RBI did, running up to the June policy. So to recap, apart from the FX swaps, they did around 5 lakh crores of OMO bond purchases, and they cut repo rate by 50 basis points. The last cut was 100 basis points. The last cut was for 50 basis point, which was more than what the market had expected at that time. So this was all around ensuring faster transmission. Now, market participants basically saw an RBI that is very aggressive in rate cuts, and they also gauged a general economic sense that the economy is slowing on the margin, and the global economy may also be slowing on the margin. So, market was quite, happily surprised in the first phase of RBI easing, thinking that we now have a very proactive monetary policy, which is ensuring that all the levers that can be pulled for policy are being pulled, given that there is some sort of an economic slowdown happening and that fiscal is quite disciplined, which is as probably it should be. However, since June, the RBI's thinking has been that, look, we have done a very large amount of monetary easing in a short span of time. So we have cut 100 basis points. We have infused tons of liquidity, 7-8 lakh crores of core liquidity. And it's important for us to signal that we are not the only game in town, that market should not, or market and economic agents should not continue to rely only on monetary policy easing going ahead. For that purpose, we think in the June policy review, they changed stance. And that is curious because, only in the April policy had they changed stance from neutral to accommodative. So it's almost unprecedented that the stance has been changed only for one policy. So in April, they changed to accommodative, and then in June, they changed back to neutral. Typically, you will find that stance has to last for most of the economic cycle as it is progressing. However, like I said, what the RBI probably wanted to ensure is that market and economic agents clearly get this signal that we have done a lot and don't expect for us to continue to do more. So from their standpoint, they were logical. We, for whatever it's worth, think there is probably a communication error there, because if you remember, transmission or monetary policy basically works through three channels. It's interest rates or policy rates, it's liquidity, and it's communication, which basically influences expectations of both market as well as economic agents. Now you can argue that even though RBI has been very proactive with respect to interest rate cuts and liquidity infusion, on the margin since June, they have also been proactive in cutting the expectation channel by decisively changing stance and then talking hawkish. So, market is therefore left with a strange sensation that, look, you have cut 100 basis points, you have infused tons of liquidity, there is a forward CRR cut of 100 basis points still pending, which will infuse another 2 to 2.5 lakh crores of liquidity. But now you're saying that stance is neutral, the bar for the next cut is very high, and that forward-looking inflation is creeping back to 4.5%. Now again, both entities are right from where they think, which is RBI signaling that don't keep relying on us, and market more and more confused that the economic cycle has not turned. The slowdown is still happening. If anything, the slowdown is more visible now, as you can see in June quarter commentary from companies. A data point of some concern: year to date, which is April to date, both corporate tax and income tax collections are actually negative 1% cumulative year on year. So they are flatlined. Like I said, a lot of company commentary is quite bearish with respect to current quarter and next quarter growth. And you are finally seeing a US economy that is also slowing. So the market's confusion is that the economic cycle has not turned. But you, as RBI, after having been very aggressive with easing, are now suddenly saying that there is nothing much I can do. So there is an expectation mismatch that is exhibiting in market yield curves. And the clear way in which the expectation mismatch is showing in market yield curve is aggressive steepening of the curve. Now, typically, you find closer to the end of a cycle, yield curve steepening the way they have steepened, right? And this is assuming that there is no fiscal stress. If there is fiscal stress accompanied with cycle turn, then term spreads can go wherever they want to. But in India, as is now well accepted, the government is very fiscally responsible. And even if they were to react somewhat to the slowdown, it's very unlikely that they will undertake any meaningful fiscal expansion. So therefore, market yield curves are beginning to react the way they would react if everything was over, the cycle was completely over. And you can actually take a view that RBI is actually telling you that most of it is over. So that is the discrepancy. From RBI standpoint, the neutral stance and the hawkish commentary is meant to signal that don't keep relying on us. We have done as much as we could. However, we think it's a communication mistake because communication is an important channel of transmission. Nevertheless, keeping our view aside, the market's confusion is that look, you started off so aggressively. There is still more easing that is in the pipeline in terms of CRR cut. We can see economic growth slowing. We can see global economy slowing. And yet you have turned commentary in a very short span of time, right? So that is the juncture we are essentially at. And that is what we have to solve for in terms of way forward. Now, our, sense basically is that even if the RBI does not cut, it's on a long pause. By long, I mean, you know, I would at this juncture hazard a guess easily in excess of a year, if not more. The reason we say that is, we can see, and like, most of the rest of the market can also see that the actual slowdown is progressing now. So let's take, for example, the global economic setup. So, as we all know, over the last 2 to 3 years, the biggest economy in the world, which is the US economy, has been growing between 2.5 to 3%, right? And that has been pulling a lot of the world growth upwards. But this year, you can decidedly see the US economy beginning to slow. And the clearest way for us to look at it is, so if you look at the headline GDP data, there is a lot of volatility there because of export minus import or trade deficit. Because in the run up to the tariff announcement, the US imported a lot of goods in order to beat the tariffs. And therefore, the X minus M component was aggressively negative, which impacted headline GDP. In quarter two, that got reversed. So the clear way to look at it, and something that the Fed has also talked about, is something called private domestic final purchases, or PDFP. And PDFP is nothing but consumption plus investment done by the private sector. So basically, from aggregate demand, it strips out government spending and it strips out export minus import. So it gives you a very good sense of the actual strength of the underlying demand of an economy. Now, just to give you some context, this PDFP in 2023 in the US grew at around 3.1%. In 2024, it was growing at around 2.93%. And in 2025, so far, it's grown at 1.5%. So essentially, the domestic economy there has halved its growth rate. But because there is headline volatility, you have had 1 quarter of very bad growth and 1 quarter of good growth. But even if you average out the headline GDP, it's basically growing at 1.5%. Now, this 100 to 150 basis point slowdown of the largest economy of the world effectively shaves off around 30 to 40 basis points of growth from world GDP. Now, that would not happen if there was one other major economy who could accelerate as the US slows. But if you look around at similar size economies like the Eurozone or China, uh, you just don't find that growth rate really picking up. So take the example of China. Because US upfronted a lot of their imports over H1, therefore China had a very strong export cycle in H1, but now that has kind of fizzled out. The fiscal stimulus that was given in H1 is beginning to fizzle out, and therefore H2 growth in China is expected to be weaker than H1 growth. Eurozone has shown some promise for higher fiscal expansion, but the currency is very volatile there. It has appreciated. So a lot of Eurozone expansion is also getting compromised because of currency strength. So the net sum of that is that global growth is decidedly slowing. And this time, the biggest change or drawdown in growth seems to be led by the US. And for that reason, we do think that despite running higher fiscal deficits, US bond yields will also correct. They have already probably started the correction process. But we do think over the next couple of quarters, you will see US bond yields head lower as well. Now, they will not be as low as they would have been had US not been running 6.5 to 7% fiscal deficit of GDP. But nevertheless, they will fall. And as far as the Fed is concerned, we believe that and we have full sympathy for the way the Fed is reacting, but you can't help but notice that the way the Fed is positioning themselves, they are setting themselves up for being behind the curve if data were to turn. Because what they're saying is, look, the overnight rate is higher than where it should be. It's marginally tight. However, we are comfortable where we are because we are looking at data and responding. Now, as we know, most of the data they are looking at is backward looking. And interest rate cuts actually affect the real economy with a 2 to 3 quarter lag. So effectively, they are looking at the rear view mirror and driving. And the interest rate tool they are using will only affect the real economy with at least a 2 quarter lag. So, for example, a case in point is the unemployment, or rather the non-farm payroll data that we got last Friday. So the headline data was weak, but there was a massive revision down of around 2,58,000 jobs for the last 2 months. And that suddenly tells you that employment creation in the US is much weaker than you thought earlier. So market is now expecting the Fed to act in September. So the point I'm making is that the way the Fed has defined their reaction function, it's quite likely that when they start to cut, they will have to catch up and therefore cut aggressively the first few times, just as when they started in September last year, they had to start with a 50 basis point cut. So we do think, to summarize, that US bond yields will also head lower. And global GDP, generally speaking, is slowing. And that is no secret. If you see most multilateral agencies, they have also marked down their global GDP forecast. Now turn to India. So you can argue that India is largely domestic focused, but that does not mean that we don't have an export channel. We don't have a funds flow channel. So if there is a slowdown in global GDP, some bit of it will also impact India. And India's local domestic growth cycle is also experiencing some bit of short-term headwinds. So corporate capex demand is much more patchier, as you hear from a lot of lender commentaries also. And second, and quite importantly, over the last 3 to 4 years, you have had a massive retail leverage cycle, which is now slowing down. So you've had all sorts of retail loan components, loans to NBFCs, unsecured loans, loans to for mortgages. All of those have been growing very, very substantially. And now there is a tapering off that is happening over there, which will also impact consumption demand. Nothing much to worry about from a structural standpoint. All I'm talking about is the cyclical slowdown. Right. So India is experiencing its own cyclical slowdown, and the world economy is also slowing. Right. So this slowdown cycle probably has some way to go before it turns. And it will turn, but probably it has some way to go before it turns. Whereas RBI commentary in the here and now, if you were to read at face value, seems to indicate that this is basically all we have, and market's interpretation of that seems to be that the whole thing is done. So the important differentiation we are making here is that if you look at the shape of the Indian yield curve, and if you were to prima facie say that, look, why is it a surprise at the end of a rate cut cycle? You are absolutely correct. It should not be a surprise at the end of a rate cut cycle if the curve is as steep as it is. If there were fiscal expansion, then it could even be steeper. However, the important difference in our point of view is that the global and local macro cycle is still running and it's still slowing. So look at it this way. If this were the previous RBI reaction function, what you would have seen so far is probably 75 basis points of rate cuts, RBI on a very dovish commentary, stance being accommodative, and market would have been happy and expecting more in the future, and therefore bond curves would not have been this steep. However, like we discussed and as is well known, the RBI's reaction function has changed. So they have upfronted their easing and in view that, look, this is most of what we could have done, thereby unintentionally messing up the expectation channel. So the quantum of total easing would have been the same. So don't get us wrong. We are not advocating that RBI should keep cutting rates to 5% or whatever, right? So probably there's one more 25 basis points of cut to go and that's about it. But the earlier approach versus this approach, in the earlier approach, it would have been more market friendly because market's expectation channel would still be thinking more is coming, and market would be seeing that globally growth is slowing, locally growth is slowing, inflation is at 3%. So what's the problem? But in the new RBI regime, it has become a problem because of aggressive communication on the other side. But the important point is, in our view, it is wrong to equate this as end of cycle term spreads, because even though RBI's proactive easing will ensure that the extent of slowdown in India is not as much and the growth recovery can potentially be quicker, it is marginal at this juncture because bigger forces are in play, including the global slowdown. And therefore, this expansion in term spreads on the bond yield curve, which means, let's say overnight is at 540, even a 5-6 year GSEC is sitting at 620-25, 10-year GSEC is sitting at 640-45, 15-year GSEC is sitting at 675, 30-year GSEC is sitting at 705-710. This sort of yield curve expansion is probably unjustified from where we are in the economic cycle, right? A rhetorical way to look at this is, now suppose overnight rate is around 5/4 and US 10-year slips to 375 and you are seeing evidence of growth slowing everywhere. Would you be buying these bonds or would you be selling them at the current valuation? And my guess is most people would say we would be buying these bonds, right? The reason I paint this picture is to distinguish between us saying that the entire bond market is influenced only by the central banker versus us saying that the central banker is an important piece, but what is also important is the global and local macro cycle. So one of the other things that will happen, if you talk to most banks today, they are struggling to or rather what you hear from general commentary is that they are struggling really to compete for corporate loan book growth. They are on the margin more worried about unsecured retail, and there are pockets of retail that is growing and they're happy to grow with. But the crux of the matter is that credit growth is slowing, and credit growth which you want to chase is now happening at very aggressive pricing. In a scenario like this, it's almost a given that banks SLR and investment books will grow. So far they are not. So far banks were happy to give out 5 lakh crores of bonds to RBI under OMOs. But our sense is over the next 6-9 months, you will find banks replenishing that SLR, replenishing more corporate bonds, because credit growth is not happening. And the likelihood that it really picks up is still probably 2 to 3 quarters away. So again, our sense is that the current steepness of the yield curve, where yields have risen very aggressively, reflects basically this new RBI reaction function, which is more friendly for the lending market and less friendly for the bond market. And why I say that is, if RBI is ensured quick transmission, so your lending rates are going to fall. Ironically, if the same government of India, not that they can do it, but just for amusement, if you were to think about this, if the same government of India, instead of issuing 10-year government bonds, would go to a large PSU bank and say that, look, give me 10-year floating loan, banks would be happy to oblige. Their credit growth would be better and bond market pressure would come off. Again, we are not saying this would happen or this is a prescription. This is just to paint a somewhat funny picture to say that the way the RBI is posting its reaction function, it is much more friendly to the lending market, because or rather the borrower via a loan rather than a borrower via a bond, right? And that is the dissonance that you are basically seeing at the current point in time. And we do think the dissonance resolves itself to some extent as global and local macro forces bring yields down, rather than continuing to look for the next RBI rate cut. Now, given this context, we continue to believe that there are decided pockets of value on the yield curve. Like we had said before, we would continue to hold that view that the bulk of potential gains are actually on the SLR or GSEC curve. We like corporate bonds largely for the carry that they offer, but we do think that most potential for mark to market gains over the next 6 to 12 months actually sit on the government bond curve. So that's where we are at. And this was a summary of what we thought the RBI policy went by.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.